Right, but Metro is a public high school. It's a
Yes.
public high school, and we have a lottery system. So we cater to all over St. Louis, Missouri.
Right.
But do you have to test? So do you test in, or how does that work? When you say lottery,
No, we have a lottery system. They submit 2 letters of recommendation, the report card. We look at their standardized test, and then we determine if they eligible, and we enter their name in the lottery.
Oh, and then
it's also
lottery.
it's also GPA. I mean, if you were in the system and you went through the Kennard, McKinley, and you had to get recommendations to go to Metro, but not every kid that applies gets in, because it's a very rigorous academic program.
Right.
I mean, it's an international baccalaureate.
They also have a legacy, I don't know what it's called, but a system where if you are part of the, if you're related, you also get some preference. But I think it has a lot to do with the parents and the involvement with the teachers and, and what have you, and the expectations and all of that.
Well,
there is some special funding.
We have a good PTO organization.
Yes.
But the PTO don't have anything to do with selecting the kids.
Oh, no. No,
And then-
not at all.
Okay,
And
everybody,
then,
so you know we are live now.
Okay. And then we do have a gifted high school too. Just to talk about, McKinley is our gifted high school that people have to test into for sure. But Metro is not the gifted high school. It's just a choice school basically, but a magnet school, but it's not our gifted high school.
It's still, you still test in a sense. You're still looking at scores. You're still looking at great GPA. I mean, you can't just go. It's not a neighborhood. You have to go through a process to go.
Right.
I think we probably need to.
Yeah. Let's go ahead and call the meeting to order. Sue, are we ready?
We're ready.
All righty. Can we take attendance, please?
Sure. Angela Banks. Here. Christina Bennett.
Here.
Joe Clark. Darnetta Clinkscale. Darnetta's on mute.
Hello, I'm here. Thank you.
Lewis Cross, sorry.
Yes, I'm not Andrew.
Sorry. Sheila Goodwin. Donna Jones.
Here.
Yvette Levy. Bobby Richardson.
Here.
Albert Sanders.
Here.
And Justin Stein.
Here.
Okay, we have a quorum.
Ralph, no. Got a noisy dog here.
Yeah, welcome to the club.
Yeah.
Yep.
Might have to.
So thanks everyone for joining in today's meeting. We'd like to go over, and I'd like to hand it over to Kristen to go over our agenda and go over performance reviews today, if possible.
Yes. Hello, everyone. So I'm glad to see everyone's face. What I'd like to start with today is just a flash. And I shouldn't say just a flash, but it's been a while since we've gone over the flash, and maybe I'll take just a little more time, given that, we have Susan on board as well. And so just making sure that we're all on the same page. But just as a reminder, the flash is just that. It is a flash. It's not our audited performance. It's 1 month's performance. So it's nothing to get ourselves too excited about, but it will give you an indication of how we're doing. Just to give some background before I go into that, the global markets did post very strong returns. The Fed did delay any sort of adjustments that they have to the accommodative monetary policy. So that means that we're really still remaining static, if you will. We also saw that tensions did ease in the Middle East, and that emerging markets in particular did show some stability. And that's going to be, relevant as we continue to think about, emerging markets in your portfolio. It's an area that oftentimes when you have a crisis is the first to be hit. However, the emerging markets balance sheets are far stronger than what we see in some of the developed markets. And so that's something to be said for that. There's also been quite a bit of value in smaller cap names, and that's played out in the markets as well. And when we think about the equity markets being up, so S&P was close to about 20% year to date. And so that's relatively strong performance, especially when we consider that we had COVID, which was quite a shock to the system. That's what moved us from being in what we continue to call a late cycle market, where the markets just kind of kept going up and up and up, in particular the equity markets. And we didn't really know how far that was going to go. It was outpacing valuations, to now being in what I'm going to call a COVID market. I hesitate to say a recession, but that said, the markets did fall apart earlier this year, and we're starting to see them come back together to a degree. But as a reminder, we all know that we have a election coming up in several weeks, and that will also have an impact on the market. So volatility continues to be relatively high. We also had some muted growth as it relates to inflation. U.S. Treasury rates did fall, and their concerns continue to be around the central bank stimulus. So again, we continue to have low interest rates. We continue to have subdued inflation. And so that, bodes to question whether we end up going into a deflationary environment. And so I think that I've just giving you a broad stroke about the markets in general. As I mentioned, I did talk about emerging market equity. When we think about emerging market debt, that too is also attractive. Valuations do tend to be better with those. There are a few countries I've mentioned that did have some currency imbalances that we are watching, and that would be some companies like Turkey, Brazil, Indonesia, South Africa, and India. But the emerging market equity managers and emerging market debt managers that we do favor, I know I'm talking a lot about emerging markets, but it is an area of growth. We do recommend active management, and they are very aware of sort of where I'm going to call the pit holes are to sort of stay away from. So I wanted to just give you that backdrop as we thought about the flash. Now, Susan, how do you want to do the flash? Would you like me to pull that up, or can you pull that up?
Yeah, I can pull it up. Do you want me to go to a certain page?
You can start with page 1. I'm just going to go high level, kind of large brush strokes, because again, it is perfect. There we go. So I guess if you turn to page 2.
Okay.
So here, when we look at the composite, and this, I'm just going to remind everybody what we're looking at. So the composite is your total portfolio. You have a little over 803 million in the portfolio. And the top green line, which is going to be your gross performance, is going to be, we haven't taken any fees out. That's just straight performance. It's not net of any fees, okay? But it's a good way to look at your managers in particular, to ensure that you're thinking of it apples to apples as it relates to what their portfolio is doing. When we think about the policy index, which is that next line, that is your exact portfolio from an asset allocation standpoint, except instead of having active management, it's passively managed. And so when we have strong numbers there, that suggests that the passive managers or the index, I should say, has done well. We typically anticipate that the index is going to be right around median, 50th percentile. Sometimes that's what we see, and there are other times that it is just up into the top decile. And some of the reasons for this can be, when you think about the index, it's a catch-all for everything that falls into that category versus a manager that really is looking at valuations. They're looking at, depending if it's a fundamental or a quantitative manager, they're looking at either factors or, business continuity, balance sheets, they're drilling down. And so, of course, there's going to be some names that the active manager is not going to have in the portfolio because of the investment thesis, which is exactly what we want them to do. However, as I mentioned, there are times we have what I call dump that just runs those indices up. And that does happen from time to time. When you move down and you look at your financial composite, that's going to not have some of the private markets in the portfolio. And then, so that gives you an indication of what those three line items are. Total equity is going to be your total equity, both domestic as well as non-U.S. And then you go down to the domestic. So as you can see, look at your 1 month performance, you're down 2.6% in your total equity portfolio, which would include both domestic and non-U.S. And so actually that shows that your non-U.S., if you compare that to your total domestic line item, your non-U.S. actually helped your portfolio as an example. So that's how we really look at that. That said, for the month, you see that we're down in your equity, whether it's 2.6 for your total equity or total domestic at 3%. And if you compare your total domestic to your Russell 3000 at negative 3.6%, you see that actually in this case, because the Russell is going to be passively managed, that your negative 3% you receive, while negative, the active managers had a positive impact on the portfolio by 600 basis points, as an example. Okay. Now, if we move and scroll out to your fiscal year to date, you see that your active managers are down negative 2.4% for your total domestic, and that's compared to 5.4% of the Russell 3000. So that, as an example, is a case where being in the index makes the most sense. There's always a debate as it relates to active versus passive. I do think with volatility coming into the market, as we move and navigate through the spectrum that we're in now, typically active management will outpace. But again, that's something that we're always aware of and making sure that our active managers are doing what they're supposed to do. So that gives you a bit of a high level from an explanation standpoint of where we are. Maybe we'll talk now a little bit about your active managers, because passive managers, as I mentioned, they're typically going to be middle of the pack. They're not really making any decisions. They're really used to give you exposure. If you scroll down, you'll see that Edgar Lomax has trailed in performance really up through 3 years, okay? While they have trailed in performance, I'm going to remind the board, and I know you were not on board yet, but Edgar Lomax up until the end of last year was our top performing manager. So this is one of those things where the pendulum at some point in time goes the opposite way. So nothing wrong with their fundamentals. They are a value manager. Value has definitely trailed growth. And so they had some poor fiscal year to date performance at negative 18% compared to the benchmark of negative 11%. So I don't mean to suggest that that's not significant, but what I am suggesting is that they are an active manager and they have, over the long term, provided significant value, but they have gone through a bit of a rough patch. And, from what we can see, there's nothing wrong or broken with their process, but their security selection and their value tilted per their portfolio.
So, Kristen, have we had a conversation with them? I mean, obviously they know their performance and they're not pleased with their performance, but have they provided any type of feedback as to, obviously selection going forward, or is it just, I understand that the index, still performed definitely at, almost 12%. But do we have any insight? Are they making any changes? Are they, they're just going to wait it out? I mean, what have they indicated?
So I have not had a direct conversation with them, but as a reminder, on a quarterly basis, we receive information. All managers have to fill out a questionnaire as it relates to what has contributed and distracted from performance. And we also look at the underlying attribution. So we do that in much more granularity during the quarterly report. Just because that time horizon is a bit more realistic and we also are relevant, I should say, as well as we audit those numbers. That said, when I look back at the performance, Christina, and I look at their style, it's really not surprising that they are where they are. And again, as a reminder, oftentimes when we have these big swings, the index will perform or often performs better than some of the more active managers because they can really make decisions that we would not actually think are prudent by an active manager. And I use this, or I say this, I've done a number of studies where I've shown, especially when we start to have a discussion between active and passive, which every few years it gets really hot and heavy and people want to know, are we in the right direction? And so what we do is I've done examples of where we have hidden the name of the manager and just had, have an active manager or a few active and had a passive manager and then show the names or the characteristic of the securities that are in the portfolio. And hands down, clients, as well as research, they always veer towards the active manager because that passive manager, like I said, they're just putting anything in the portfolio that fits from an exposure standpoint. And oftentimes the names may or may not be viable as it relates to a long-term business. That said, short answer to your question, it is mostly stock selection and their value tilt is what we're seeing. Their process, from what we can see, what we can read, what we've talked to them in the past, and when I say in the past, within this year, has shown that it's been broken.
So
And
I have a question. Go on. I'm sorry.
Go ahead.
Okay, my question, and I think you touched on it. I thought you were going to, but you said for this year. I'm wondering, how have they performed historically? Have we seen them be negative and then come back? Is there vacillation? Historically.
Historically, up until around I think it's December timeframe, Lomex was one of your best performing managers. So when you get your quarterly, you know how you have those ones that give you the ranking?
Yeah.
Lomex was consistently, probably about 4 or 5 years, one of your best performing managers.
Okay.
So this is the first time that we've seen any persistence around negative performance from them in years.
Okay.
And so again,
Kristen, can you explain, when we're looking at these 1 year, 3 months, fiscal year to date, in the 5 years, it is not, if we look at 1 year, it's 1 year as of what? This is August reporting.
Mm-hmm.
So it is 1 year, 12 months from August to August.
Yeah, actually, this is September, Christina. So it will be 1 year. It's the trailing
September
1 year.
September.
Right. So this is calendar year.
Right. This is not calendar year representative here. This is 12 months, right? As of trailing 12 months,
Yes.
Trailing 36 months. So when we look at these on a quarterly basis, just so the committee knows, when you go back to your December report or whatever reflects, let's say February, we'll look at December 31 numbers. Sorry. That number, if you pulled out a quarterly report, those numbers would be different.
Yes.
And that's, so the reason is because this 1 month is 30 days. This is 90 days as of September, not as of and so the only year to date is that fiscal year to date column for 9 months, and then the 1 year compares 2020 to 2019 September numbers. So I just wanted to make that clear to the committee members that, if you pulled out a different quarter, those numbers are going to be different every single quarter because it's a trailing 12 months. It's a trailing 36 months as of that quarter date.
Yep.
So
great explanation.
Right. So when we look at Edgar Lomax, we look at Edgar Lomax on a calendar year basis so that we can see what they were. Even though our compliance report for manager monitoring is on a quarterly rolling basis. So we can do a training on that, on how we look at managers and how we monitor the watch list so that everybody knows. But I wanted everybody to make sure, if that wasn't clear, that these are quarterly numbers and not annual numbers as of calendar purposes. Sorry about that, Kristen.
No, I mean, that's a great point. And it's important because it's also endpoint sensitive. And so while you may see since inception and say, that manager doesn't look that great, you have to remember that because of the endpoint of it, you may have some really great months or quarters or years for that matter, depending on how you're looking at the portfolio performance, that have dropped off, and you may be picking up some not so great periods. And so, like I said, I believe it was either November or December of last year that we started to see, some erosion of that outstanding performance. Because like I said, I have Lomax in a number of my client portfolios, and they were just a high flyer. And they were a high flyer during a period when growth equity managers were really outpacing value managers, and they were still able to do really well. And so we did kind of disaggregate that a little bit to see, okay, what, and they just had superior stock selection, quite frankly. And so, I like I said, what goes up must come down. I mean, I'd like to say that all managers and really good managers are always going to have strong performance, but, they're going to have ebbs and flows, just like anything else, like, if you will. But most importantly, I think it's important to note that we don't feel at this juncture that there is any sort of model or process breakdown.
Yeah,
I have a question.
Please mute when you're not talking, because I'm getting some feedback and it's hard to understand some of the conversation. Thank you.
I muted myself when I'm not talking. That may help. But Angela or Angie or Bobby, did you have a question? I'll mute myself, and then when I speak, I'll come back.
Okay. Oh, you want me to go ahead and ask my question?
Yeah, I think
go
she's
ahead, Bob.
ready. Yeah.
When you look at the first row where it say 1 month, you see all negative signs going down that whole column. Is that good or is that bad?
So, so the monthly performance, as you can see here, was not good for September. So whether it be your performance, which would be the green, the policy index, which follows it, financial composite, if you scroll all the way down, Mellon Equity, which is your index, the S&P 500, which is your index, scrolling all the way down. And, if you go to the following pages, you'll, see similar, it's not my screen, but, you would see similar information. So September wasn't a great month. The areas that you saw, like if you look at the global equity though, you see your Exponus manager, which we're going to talk about in a little bit. Again, the total global is down 1.3%. Now that's actually better than the MSCI World, which is down 3.5%. So this is a case where while your manager was down, and Exponus is your manager of manager, which focuses on diverse and emerging managers, but you can see that negative 1.3 outpaced the negative 3.5. Again, very short performance. So while we need to go through it and document it, it's that quarterly, then 1 year, then 3 year, 5 year, and 7 year, which we really want to be focused on because, again, we don't want to make knee-jerk reactions to 1 month because it's just not a long enough period of time. But that said, to answer your question directly, Bobby,
yes,
you see negative, it's not. That's not what we want to say. We really want to say positive.
Okay.
And
We can go back, Susan, if you can go back to the front page. And see, conversely, if we go down to your growth managers, you can see when you see your 3-month, even though Intech and TCW did trail the benchmark, you still see they're still posting low double digits, 12.5%, 10.6%. Those are positive. Those are well above your actuarial rate of return. So, again, we like to see them beat the benchmark, but sometimes there are reasons why they wouldn't. And when we go to the quarterly report, we'll actually be able to see how they compare to their peers. Because benchmark, while it's the same exposure or types of exposure, their peers are going to be other active managers that fall into that category. And to give you even further, if you keep scrolling, look at the 1-year performance for TCW at 40%. That's phenomenal and unsustainable. But we'll take it, right? We take it where we can, and that's why we want to have a program that has managers that are going to perform slightly different with slightly different return patterns. They look to provide alpha to the portfolio. Otherwise, when everything goes up, it'll go up at the same time. And when it goes down, it'll go down at the same time. And we won't have any smoothing, if you will. We want to have a smoother up, which means it's, you'll have managers that have more volatility, but the net will be sort of an upward trajectory that is smooth. And the goal, of course, is to be above your actual rate of return. So maybe turn to the next page.
Kristen, can I make a request that if you are not asking a question, to please put your technology on mute, because we're getting some feedback. And that way we will maybe be able to hear a little bit better. Unfortunately, my computer keeps going out, so I'm on my phone, but it's not as easy to hear on the iPhone as it is on the computer. So thanks, Bobby. And let me see. Yep, everybody should be, except Kristen should be on mute. Thank you.
So I will continue talking about our SMID portfolio. As you can see, you have Westfield, Systematic, Financial, and DFA. DFA is going to be your quantitative manager. Quant managers, again, they go on factors. So that's more computer or model driven. And so trying to understand whether they are evolving is something we're really focused on and looking at from a firm standpoint, meaning NEPC is definitely looking at that. Because if you think about the last 10 years almost, equity markets just kept going up and up and up. And so there are many managers that were really able to just ride the wave. So now we're trying to disaggregate those managers that going forward, now that we're in a more volatile market, things aren't just going up, 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 are going to be able to earn their keep, if you will, versus those that truly have, a unique forward-looking process that's adding value. So I would mention that about DFA and Systematic. Both of those are very quant-oriented managers. Westfield is going to be more your fundamental manager. And as you can see, while they still had negative performance by 0.4%, still outpacing the growth, Russell 2000 growth, when you start to scroll out to their 3-month and fiscal year to date, they've done well during this period. Growth managers have been, on gangbusters. They've really outpaced. So again, we take it recognizing that value hasn't done as well, but we would, at some point, growth is not going to be doing well. And actually, we've started to see some support for that as you move into the non-US market and emerging markets. We're starting to see more value opportunities percolating to the top. So you really have to look at it holistically. But again, when we think about that year-to-date, fiscal year-to-date number at 12.4%, we're going to take that, and you can see where Systematic and DFA really fell apart during those periods. So again, we're always looking at the managers, endpoint sensitivity. These are managers that have been with you for a very long time. So we're not looking at just, taking someone out immediately, but we do watch it to see if things either turn around and what we're going to expect going forward. As we move to the total international equity portfolio, once again, that represents about 10%, a little over 10.5% of your total weighting of your program. You have Fidelity and Causeway. Causeway has definitely struggled. You see that fiscal year to date at negative 16.6%. We have had some calls with them. We don't see anything at this juncture that's broken, but again, you keep watching them, because if it becomes persistent over long periods of time, which, even if we go to the 5 years, there's still a little over 200, almost 300 basis points behind. We need to kind of understand what's going on there. So again, when we get to since inception, though, they're still with that, dramatically negative performance for fiscal year to date. You see that we're still above their benchmark when you look out since inception of May 2005. So again, we're looking at all time periods, just to make sure that, when we start to think something has erosion, that we have persistence behind it before we make a decision. And the same as if you, to a lesser degree, if you see Fidelity. I mean, Fidelity's 5-year number, they were ahead. So their erosion really is, actually, I'm sorry, am I looking this right? Yeah. So their erosion was, they've actually been ahead. If you look all the way across, starting from negative 1.3, which of course is negative, but still ahead of the benchmark. And then you scroll all the way across, fiscal year to date, they were 0.5 compared to negative 7.1. So that was a huge amount of alpha during that period. And then you go all the way to since inception, they were up 5.7 to 4.4.
And Kristen, alpha again is excess return over the benchmark.
Yes, my
terminology. And then the only thing that I had, Kristen, on this was that to me, it's a red flag that Causeway is double digit negative. I mean, they're 700 to 800 basis points negative compared to their peers and the benchmark. Mm-hmm. So that's one I really want to watch and see where they are and look at how they pan out in the formula for probation. So
absolutely. We are absolutely following that. And just to make another distinction, and I hate to sound like a broken record here, but one of aside from the Fidelity and Causeway just being two different firms, Fidelity is more growth oriented and Causeway is more value. So the value managers they haven't been the chosen ones for the last few years, actually. I mean, there's even our debate, and I don't think we have a conclusion on it. I mean, we tend to think that you want to continue to have diversity in the portfolio, but there are some that would argue that maybe growth is never coming back. And what's the point? And maybe you shouldn't even have value is never coming back. And what's the point? And maybe you should never have value in your portfolio. I and NEPC, my firm, we're not at that point, but we are watching the value. We are, talking about whether or not we should be scaling the value down a little, because we know that the markets right now are favoring growth.
But with Causeway, it looks like they've been trailing even the benchmark for over 3 years.
Mm-hmm. Well, once again, you have some significantly strong performance that's being baked into the negative performance, I should say, that's being baked into the numbers. So that will, if you have a really bad 1 year, it's going to flow out to your 3 and 5 year as well. Okay, so they've had some pretty significant negative performance in the near term, and that's been floating out. And so as we look, what we would like to see is that starts to turn around, and over time that starts to once again flow out to those later years. But that 1, 2, I think if you look at calendar years, 2020, 2019 have not been kind to their process in particular. But I will remind you, just like Lomex. There's a point in time, especially when we, a few years ago when we were thinking about the brokerage policy. I don't know if you remember, and Causeway was not, they do now, but they were not meeting their goals for the brokerage policy. And, we were contemplating getting rid of them. But the problem was they were in the top, they were like number one. So, then it became a philosophical question. So what we ended up doing was really pushing hard on the brokerage piece to ensure that they were utilizing diverse managers or diverse brokers in their trades, really elevating the importance that plays for St. Louis in particular as their client, and our partners should be organizations that respect that. And so they ultimately got it together and started providing much better numbers around that. But it was a struggle because I think it was you, Christina, wasn't it? I feel like they had made some promises and then really didn't keep them as years ensued.
We terminated them because they refused to comply with our brokerage program. And when they got news that we terminated them, they kind of backpedaled and said, okay, we will go ahead and comply with this. And at that point was probably 2016, 17. They were really good. They were really good performers. I haven't seen that performance since then, but they do comply with our minority broker program now. And they don't do that many trades, but I'd like to see how they pan out on our compliance. And we've brought them in before.
Yeah.
We've brought them in before, so this isn't the first time we would put them on probation. I want to say late 2000s we put them on probation, and then they turned around and were a great manager. So again, ebbs and flows, but right now it looks like they're down on the luck. And I know they've made some changes in their organizational structure. I don't know if it's portfolio managers. I can't recall, but it's something that I would like to maybe just see if you can reach out and they can respond in writing.
Okay. Okay. And I know I'm taking a little bit more time today with this, but I just thought since this was one of the main thing on the agenda, it's a great opportunity before we get busy doing searches and other things to, just go over performance. As we go down to the emerging markets, as you can see, that 3 month number at 7.2% is standing out. That's better than the domestic performance was for the 3 month period. And of course you have DFA, Invesco, and LMCG. LMCG unfortunately lost their portfolio managers, ended up shutting the portfolio down. And so we'll be looking to reevaluate we'll be looking to reevaluate that manager or that slot, I should say, and either reallocate to the current managers or think about how we want to redeploy those assets. So I believe that Andrew actually started the process, and I believe Susan has finished up the process of the liquidation of that. And for the time being, as mentioned at the last meeting, we'll be looking to use that for benefit payments.
Yeah, so we have 18 million that was redeemed. So we would still have a little more than 9 million with that.
Mm-hmm. And that is, Susan, when is that final wind down coming? Because I know they had some pretty aggressive timelines around that.
Yeah, I'm not sure what the exact timeline was. The $18 million that was moved into our account on October 5th. So we will still need to fund retiree payroll. That's going to get us through November and December. But January 1st, we would, we don't want to guarantee that those funds are going to come in that we're expecting from SLPS. So, we could look at that 9 million from them to help with that January 1st payroll.
And so, Sue, correct me if I'm wrong, but they transferred these assets into an ETF. correct? As of early, like last month or so. I mean, the quick transition was going to occur before our last meeting. So I was under the impression that once they made the transfer, then it was open for redemption. So did Andrew just only pull 18, or?
That's correct. He just pulled the 18 million.
So maybe put that on your parking list if that is something that he did just to pay retirement benefits for fourth quarter, or was he just going to leave it there in the market in an ETF to be able to see what it does and then pull come December?
Yeah,
I can speak. Oh, I'm sorry. I can speak just a little bit to that. I know he's not here at this point, but at least from my conversations with him, and Susan, please share if there's something else or different than that you discussed with him. But I think in lieu of doing a big termination, a withdrawal to meet the benefit payments was the goal. Ultimately, with the knowledge that there would be a termination, so I think he just wanted to make sure that he took care of that fourth quarter until the new decision makers all kind of got their sea legs and could kind of move that forward. But my understanding was not that he was looking to see any sort of rebound, coupled with the fact that we'll be looking, and we view pretty strongly that in this space we want to be with active managers. And so the ETFs, while give you an exposure, I think that there's some better opportunities if we want to look in that vein, as well as we talked about small cap EME, which would likely come out of this component as well. So there is some rebalancing to be done. We are towards the end of the year. We are again, the themes that come out once a year now. For those board members that have been on the board for a while, we've now upped that. So we're looking at it now quarterly just because of the volatility. So there's some themes that are remaining persistent and consistent. And those, of course, are the ones that we're more comfortable moving into. And then there's some volatility that continues in the market. So, but emerging market equities, emerging market debts, as I've mentioned, has consistently shown where there's quite a bit of value. So I think that that's just another conversation as it relates to how we want to handle that 9 million. But in the short term, if we need cash, it makes sense to go ahead and liquidate that, because we're not going to be, we do need to get out of LNCG in the near term.
Yeah, and the only other thing I would add to that, Kristen, is that, again, like you mentioned, it would be termination of the fund. And so Andrew mentioned, just waiting until, the board decided what they wanted to do. And then, we could take a look at that 9 million and figure out, are we just terminating? Are we transferring that to someone different, how we were going to do it. So it was just to get us covered, for the next couple of months.
So Kristen, I don't know what the outlook for emerging market is. And I guess my gut tells me we're going to have, if we decide to replenish these assets in 2021, my gut is to liquidate and leave it in cash, where if there's any volatility in the market, whether it's an ETF or not, we're not going to have any negative depreciate or negative reduction in capital.
That's spot on. And, as I've mentioned before, one of the themes that we do have is maintaining a certain level of liquidity, given the volatility in the market, given COVID, given we don't know if we're going to have a double dip, and making sure that, I have clients that are doing a quarter to, 3 to 4 months worth of, liquidity that they need, just to ensure that there's no issues when the time comes of not being able to get out of anything or any sort of clawbacks or the like. So I would agree with your, I think, intuition as it relates to what makes sense. And I believe, like I said, that was, what Andrew and I had spoken about, but I think he wanted to just do it in a slightly different manner as it relates to liquidation and termination. because we needed to act fast, if you remember. So, but we still need to act, I think, fairly quickly. So I think that we're getting to a point we do need to start thinking about actually terminating.
Right. So can I ask any other members on the committee here, your input, your insight into, what your preference is so that we can have a discussion on that?
Well, personally, I am very much in favor of, having just the cash. And I won't go into reasons why, but I think that having some additional cash on hand is a good move.
Anyone else? Darnetta, Bobby, Justin, Albert?
I like the fact, I know we have to move it, so I say we move it as fast as possible. And if it's the best thing to actually do the liquidation for the, just to have it there, just to sit there, I think that's what we should do.
I concur with the others that we need to move in an expeditious manner on this. Chris, one of the things that we wanted to see, I guess, at every other meeting is the trouble list. Were they on our trouble list?
Oh, our compliance manager compliance list. I'm not sure if Kristen, is it in this report? Our watch list.
That's what it is.
That would be in our quarterly report.
Okay.
So, we had started to have some concerns about them. I'm not sure if they made it to the trouble list before they lost their portfolio managers. But we had talked about the fact that, that we were starting to see erosion in the value. So they were a 1-rated manager, and they had been downgraded, but they had not been downgraded. Oh, I'm sorry. They had not been downgraded to like a sell. They had just been downgraded from the perspective of, the real 1-rated managers are like the top, bubble to the top, really high conviction. And we had started to have some concerns around whether or not their process and how they were looking at things were really going to play out as we at the same level. Now, we did not think that they were going to close down. That was, otherwise we would have downgraded them and we would have had a sell on them. And so we didn't have that, but we had started to have conversations about sort of the viability of whether they would be sort of that high flyer going forward. And again, this is coming back to a slight, I won't say change, but enhancement in the process of we've really been on a 10-year run with managers and really trying to separate those managers that have just risen with the tide because everybody's rising, because the tide is rising, versus those that are really got something unique. And in particular for more quantitative managers, which LMCG is one of those, they've got to change those factors and they've got to be very intuitive about them and forward looking because some of the factors that played out before have, for lack of a better word, become sort of stale. And as things become stale, if you don't have something to replace them that is robust, then you start to fall behind. And so again, we hadn't concluded that, but we were starting to question that. And so there had been a downgrade.
Do I have any other comments before I ask for a motion?
Yeah, I just have one, which is probably a bit off of the beaten path, but I guess I'm just wondering about our allocation. And I know that we have a period when we kind of look at the total allocation and whether or not we think it's in a good place. And I don't know if that's every 5 years or what. Can you remind me kind of where we are in that process?
Yeah, so we do a full asset liability study every 3 to 5 years, but we're looking at the allocation really on an annual basis. The goal there is to ensure that we're making tweaks along the way so we don't get to a point that the portfolio has to be overhauled, because that can be very expensive. And as you see themes, as you see things changing, we like to tweak as we go, versus like we've got 6 different asset classes that we have to completely overhaul because we no longer believe in it, because we just waited to that time period. So typically we do it in that January, February timeframe. We're getting towards the end of the year. They're going to be, as I mentioned, they've been reviewing the underlying assumptions on a quarterly basis, but we're almost into November, which means they're going to do an even deeper dive at this point, with those results usually being a draft being posted in December, with it being rolled out in January. So, but to that end, if there is not anxiety, that's not the term, if there's a feeling of urgency to review it, I would not be opposed to doing it before then. We probably wouldn't be able to get it done until the December meeting though. So, you can make that argument. Do we want to just go ahead and wait a month to make sure we have the most up-to-date information? But as I mentioned, because we're now reviewing even more frequently on a quarterly basis versus what has historically been once a year, it's likely going to not be as many changes from sort of that September 30th to December 31st.
So Angie, I think I would like to have Sue put on, hold on. Sorry, somebody else is trying to walk in and have their Zoom call in my space. Let's pencil Sue in for January tentatively, and then maybe February a full blown if we can't get to it in January. The ability to look at our asset allocation, because if you recall those meetings, we talk about our allocation, our policy, and then we make recommendations to change, tweak some of the percentages. And it's better that we do it sooner rather than later, because we have had quite a bit of volatility in 2020. So it just behooves us to be able to put that on the calendar.
Okay, and Christina, are you talking about the full board meeting or the investment committee, which is my understanding that typically—
Well, it would be the January investment meeting, which would then again, if we talked about it, we would have to approve anything at the February full board meeting.
Okay. And I just asked because it was my understanding January, the investment committee didn't typically meet, but if
I think we're going to meet given the circumstances.
Okay.
So that if there's anything we have to do or change, or then I'm not a big fan of trying to call emergency meetings if we don't have to. And so therefore we meet in February for the full board. So if, does anybody have any comments on that, Angie?
Oh, that works.
And I think that
works for me.
Okay. I guess my concern is that having the revenue available for the start of January, and I think Sue had mentioned that we could have the 9 million available for distribution for the payroll and so forth. So waiting another month, I'd rather do it in January, but you all tell me what you think.
You mean the asset allocation conversation, Louis?
Yes.
Well, asset allocation conversation is going to talk big picture about policy. And then we would need a full board approval. So a recommendation would have to come from the investment committee. And then we would have another discussion in the full board meeting to be able to have a full board approval of any changes to the recommendations to an asset allocation policy.
Okay, is that something?
Is that what you're saying?
Yeah, exactly. Is that something that the rest of the folks would like to do? Because I don't want it to.
I agree.
Mm-hmm.
Yeah, I'd rather schedule it and do it, in January.
So Darnetta and Louis, do you want to have the discussion in December? Or do you want to have the discussion in January?
Whatever we
Yeah.
can do so that it can start up and we can make the necessary move in January. I guess that would mean that we'd have to do some things before January.
Well, we don't have a full board meeting. We do have a full board meeting in December, correct, Sue?
Yes.
But
we have-
usually we have that discussion, but it's, we have the budget discussion come in December, at our meeting. And I don't recall who the budget committee chair is, but we usually have to have a budget committee meeting before the full board in December. So, we have to have that meeting come up, and that budget meeting really is irrelevant when it comes to the investment meeting. But,
Okay.
I mean, I think the one thing that the board has to keep in mind is for January 1st payroll, you know, we would need something else because we can't necessarily count that funding from
Exactly.
SLPS is going to come in to meet that January. Well, it'll
Exactly.
actually be January 2nd payroll. So,
Right.
So Sue, I guess for our information is, do you have enough cash flow to pay benefits for fiscal year 2020 or calendar year 2020?
correct. If we're looking at December 1st, we have November 1st and December 1st covered. It's just that January 1st.
And what is that plug? What is that number for January? Is it
Going to be around 9 million.
okay? So usually I guess Andrew left instructions on where he pulls funds from for that December, because Andrew obviously has a system where we didn't liquidate $27 million of a portfolio to pay for benefits. So he pulled them as he was pulling, I guess, gains or whatnot from the portfolio. So let's figure that out, because I don't want any shortfall for January. And if we're going to take this 9 million, that's great, but that doesn't guarantee that the 9 million we pull is going to be 9 million or 8.7. I don't know what it's going to be. So I guess I would make the recommendation that if you're still in contact with Andrew, to figure out where he pulls in excess so that we have a cushion. I'm just not comfortable not having a cushion. And then make that decision. And then we'll get the motion to do this 9 million so that we're covered for January. But either way, whether we have the asset allocation changes, the asset allocation changes is really not going to drastically terminate or change our policy. Our policy, when we do an allocation change, it shifts money from one manager to another, or that shift occurs over time. It's not gonna help us with our cash flow. Correct, Kristen?
Yes, that is correct. And just to comment, I know, people want to get things done as quickly as possible, but if you remember, we have an election coming up. And so I think that it may be worth waiting a few weeks, which is what it would be between December and January, to ensure that we capture, while I do believe that the powers that be are making two parallel outcomes depending on what happens with the election. But once that election has happened and we see how it's either a maintaining of power or transferring of power that's going on, that's going to have an impact in the markets, impact in the volatility. So I think it would be nice to be able to capture that with that as a known factor, which would come out in those actions and assumptions that will be rolled out at the end of December, which we could put into play in our, if we wanted to evaluate the asset allocation in January. So again, we can do it in December. I just think that we'll be using slightly staler data compared to what we would be able to utilize in January.
I agree. I think the taking of distributions should occur in December to fill the nest egg, the markets are going to react positively or negatively given the election. And, we're not going to speculate. Everybody else is speculating. But I think that, so I'm going to call.
So I'm
for-
sorry, excuse me, can I make another suggestion? And I apologize. Usually there's a lot of selling in December because of tax reasons. I would almost suggest, again, this is just a suggestion, it's the pleasure of the board, of course. Maybe you even think about doing any sort of liquidation that you might do in end of October, beginning of November, if possible.
So you're saying tax harvesting in late October, early November.
Right, yeah, so getting in there ahead of when we're gonna definitely see, you know, selling for tax purposes. That always happens in December, no matter what.
So
Mhm.
maybe early November after the election?
Sorry?
No, before
Yeah.
Sue.
You
Yeah,
want-
I'm saying we might want to consider, you know, and again, I don't know what the purview of this body is in the sense of, can you go, you know, do you have to have a board meeting to say I'm going to sell, or is that something that's already instilled in the process? But if at all possible, I would look at trying to liquidate a bit to make sure you have that
Exactly.
liquid money for January.
That's right.
In October, if possible, beginning of November, you know, before the election, actually, because the election is going to create some volatility. And then under normal circumstances, as you get to Thanksgiving and December, you have the tax lot selling for those that do it. So that would be my recommendation there.
Chris,
Yes.
Which one?
I concur with Kristen on that, and I think we need to move expeditiously and get that done, whatever we have to do, whether we have to have another meeting or whatever.
No. So we've never gotten into the conversations and discussions of when Andrew pulls and where he pulls, historically has
Right.
pulled money from. That's always been the discretion of the executive director based on what they have in front of them, because they can pull live performance reports or balances. So Sue, I'm not sure if you still are having conversations with Andrew or not. But you know, I would look and see and have Terry help you figure out where he pulled historically his funds from in the month of October, November, and December. And then I would like to ask for a motion to liquidate our balances in, hold on, an LMCG emerging market portfolio with approximately 9 million.
9 million.
And then that way, and terminate the relationship on the record.
I second.
Hold on. No, I'm asking for someone to make the motion.
Oh, okay. I'd like to make a motion to liquidate $9 million from our fund with LM, what did you say?
LCMG.
LCG? I'm sorry.
LMCG. LMCG.
Okay, LMCG. I'd like to make a motion that we liquidate, is it close the account with LMCG and take the $9 million out of that fund?
So liquidate and terminate.
To liquidate and terminate.
Can I get a second?
that. This is Darnetta.
You have a second and a third, Darnetta and Bobby.
Okay.
Okay. So let me
Sue,
take-
can I get a roll call vote, please?
Sure. Angela Banks,
Yes.
Christina Bennett,
Yes.
Darnetta Clinkscale,
Yes.
Lewis Cross,
Yes.
Donna Jones,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
and Justin Stein.
Yes.
All right, so you have 8 yeses.
Thank you. And Sue, I appreciate you facilitating that process.
We'll certainly do that.
Kristen, can we move on? We've stayed on page 2 for quite a while.
Yes. So at this point, you know, maybe we can just move on and probably wrap this up really quickly because this is a flash. You know, I've already touched base on the total global equity, so we can move to the next page. Fixed income, as you can see, when you look at this page, you see that we, over the fiscal year to date, we were up 4.7, trailing ever so slightly. You know, core bonds, which is your domestic fixed income, and then, you know, go down one further, that next core fixed income, which is 8% of your portfolio. It's performed okay. Again, still trailed a little bit, but you have positive performance fiscal year to date at 5.4%. You're 3 months ahead. You have both Manulife and Earnest Partners there who have performed fairly respectable. The delta or the difference between a top quartile and median is not going to be huge as it relates to that. Exponents, which is showing a little bit of, well, very well on the 3 month, trailing a bit on the fiscal year to date. They had a bit of bumps, but again, this is a manager that was really very strong 6 months ago. So again, I don't think that any of these managers have any broken process. We'll continue to watch them. As we move down to your absolute return fixed income, you can see Loomis Sayles Strategic Alpha Trust. They've performed nicely for you. In particular, when you look at the fiscal year to date at 6.3% performance, which is outstanding, and then 1 year at 7.2%. So definitely had some nice value there. Your Tips, which is a new manager, we just instituted them almost a year ago. So, you know, and it's an index fund, so they're doing exactly what we expect, which is right on top of the index fund. So I'll move down to the global multi-sector, which we reduced. As you remember, we had a pretty significant exposure to GAA. And as we start to revalue and reconsider, Angie talking about kind of asset allocation, this was a decision we made at the top of the year that, hey, while we'd had close to, I think, 12% in GAA and global multi-sector, we don't need that anymore because it doesn't provide as much of a value. So if you think about here, we have Neuberger Berman, which we hired in 2017. They have over time provided value. 3 month is out, done well. The year, it's been trailing a little bit, but and just to remind you, what does that mean? It means that they're in emerging market debt, they're in, you know, core bonds, they're in high yield, maybe some CLOs. So they really have the ability to go across the spectrum on the fixed income area and giving you exposure to areas that they think are going to be best suited for the portfolio without you having to actually go and do an RFP. So anytime we have these, what I call flexible mandates, it's just to give you I guess, an umbrella for and discretion to the manager to be able to look at various opportunities without you having to do a dedicated search, because that can take a long time, and the opportunity may be eroded by the time you actually get in it. So this just gives you that flexibility. So that's why we have those, just as a reminder. And then of course you have EMD in the portfolio, which over time I think is going to be benefited. This is a blended, so that means that it has local currency as well as sovereign debt, which would be US based. And so that is the way we view the best way to implement. While local can give you slightly higher returns, the risk profile of local currency only is much higher. It's just the risk trade-off I don't think is worth it. And so we've moved into a blended piece for there with Lazard. Yeah, so I think that's what captures that page. Susan, maybe we can move forward. And here again, talking about the GAA, global multi-sector and then global asset allocation. Both of those are flexible mandates. As mentioned, this was significantly higher, and we are, continuing to evaluate this. This is an area in particular when we think about asset allocation that I would be recommending that we probably bring down even further, and definitely probably eliminate at least one, maybe two of the managers. I don't know that we need 3 managers in this space. Historically, when we got into GAA, which as you can see was, 2006, for the most part, this was an opportunity to get access to areas that we were not historically able to get access in the portfolio. Since then, your portfolio has really been built out considerably. And so the need for GAA has been lessened in the portfolio. So making sure that we have a real role for it and we're not getting those exposures elsewhere, is going to be paramount in determining what level we maintain. So that's just because we were talking about asset allocation, I wanted to point out an area that probably would need some attention per Angie's comments. And then as we move down to hedge funds, once again, an area that we have reduced over time, we have Grosvenor, which has done well for the portfolio, as you can see over time. You know, the fiscal year to date at 9%, and then 1 year at 12%. This is going to be a diversified, broad, diversified hedge fund. The pool brings in a lot of different strategies. And then, of course, White Box Multi-Strategy Fund. They too bring in some slightly different components, but are a bit more focused than Grosvenor. So those are really the two. In trust we've been winding out of for a while now. So we should, you know, we're at 1 million. And so that would be a follow-up item, Susan, at some point, you know, just to kind of figure out when we're going to be getting the remaining of that. Hedge funds do tend to hold back a bit in the callback as you're liquidating out, but we should be getting to a point where we have everything. They're not even a line item. So
Yeah, it's been a while with Entrust, and so again, in our asset allocation, when we look at it, we can eliminate a manager and maybe move it over to one of the other two managers. But again, it'll look on the asset allocation if we want to keep it at, you know, 6.3% or 6% or whatever, but moving it or taking the funds and liquidating it into cash when we do get it. So again, that asset allocation will come into play here on that policy change.
Yep. And actually, Christina, I think we're actually already have reduced hedge funds down to 5%. So we're a little over, I believe. And we've terminated Entrust. So really this is residual that they actually owe us. So I think at this point, they've had a decent amount of time. So we should be talking to them about when they're going to send the remaining balance. And at this point, unless, and we'll have the asset allocation discussion, but if we're going to keep it at 5%, I think that hedge fund money goes somewhere else, actually. But we can talk about that. Yeah.
Right.
And maybe we can keep going so we can wrap up. Okay. So then now we're coming to the real estate and more alternative portion of the portfolio. This is never going to look great from a monthly basis because we really, it's a lag performance and it's on a quarterly basis because it's private markets for the most part, with the exception of the real estate UBS Trumbull funds. And those funds we are actively looking to move away from. You see big real estate, which is Basis, and Elm Tree, which I think Christina's brought up a couple of times, and they have a new fund. Those are more the private markets, and that is the trajectory and direction that the board has given. But as you invest in private real estate, it takes time. It just doesn't happen overnight. We don't want to have that vintage year concentration. So we are pacing that out. So we are due. It's time to start to think about a real estate pacing plan. And, you know, the nice thing is both Elm Tree and Basis will be back in the market, so we can utilize that. We are filling out our non-core portion first for a couple of reasons. One, and both Elm Tree, which
on there pretty easy, I think. Yeah. One end though, you gotta get on the right end.
Justin, we can hear you.
Oh, I thought he was talking to me. Basically, the Elm Tree is triple net lease, which is value add, and Basis is more like real estate debt. Both non-core. We think that there's more opportunity in non-core. Despite the COVID, there's still great opportunities out there. So I think we should be, you know, looking in that area. I will say that drawdowns are a little slower right now because of COVID, but there's still great opportunities, especially in like real estate distress. That's going to be across both the real estate as well as private equity, which I'll now pop down to. We don't actually have
Kristen, where's Basis?
That's big.
Oh,
big
can we
real
put
estate.
parentheses Basis? Because I know that some of us were on the board and you kept saying Basis, and I'm like, that's big real estate fund. Yeah, can we put in parentheses that's Basis? Because
Sure.
that's how when they did their performance, we didn't, you know, we didn't know them as big real estate. We knew them as Basis.
Yeah, basis is really going to be the firm, and Big Real Estate Fund is the name of the actual fund
Okay.
versus firm.
And then just so everyone else knows, the 133,000 for Elm Tree is because they sold, we invested in the portfolio. We got a great return, if you can see. And then they sold their portfolio to a Chinese company. And this is just the balance remainder that's outstanding. So I just wanted everybody to know, why would we have, you know, a manager with 133,000? That's just residual.
And so as we continue to move down, private equity, private debt, we'll usually have a separate report that will talk about them. We included in this report with the expected returns, or the actual returns, excuse me, but the best way to really judge on whether you have a strong fund or not is the internal rate of return, not the modified Dietz, which is modified Dietz return, which is how geometric return essentially, which is what is included in here. So we do use it, but you will get a more appropriate report. So you basically get a double report, if you will, that comes out on a quarterly basis with the quarterly performance report. So these numbers don't really often get updated as much for the monthly basis because they really are audited on a quarterly basis. And that's just the nature of the private markets. That said, as you can see, we have both private equity and private debt. And the private debt also throws off income. So that's nice for the portfolio. And I think that may be the last page.
Yeah, it is.
Okay. So maybe we can, unless there are any questions, we probably spent a significant amount of time on the flash, but I thought it was good just since we didn't have anything else on the agenda to go through it. It's nice to do that every once in a while in this detail, but we can maybe move to some of the other items unless there are questions.
No, and I think on our agenda next was going to be just the update on LCMG, but we discussed that. We've done it already. So the next one was the update on exponents. And the only question I had for you, Kristen, was on the flash. Is it when we do the fixed income and we have exponents as of inception as of 2015? Mm-hmm. The question I had was, do we footnote that basically since 2015, I don't know if it's the same manager. Do you know what I'm saying? Because I know there were some changes.
Yeah. So on the fixed income, let me clarify. For the fixed income, it's actually going to be the same manager, just a different name. So if you remember, we actually hired NCM. NCM got acquired by FIS. FIS changed their name. So this is actually the same portfolio manager. Yes. Okay. This is not a manager of, this is not a manager of manager structure. This is actually a portfolio management team that was lifted out. And actually, I'm sorry, I missed a step. NCM was acquired by Piedmont. Piedmont then was acquired by FIS. And then FIS, and in that acquisition of Piedmont, the structure, any of their sort of direct mandates with the portfolio manager, and they were managing it in-house, remained. So basically that was sort of the marriage between Piedmont and FIS, was to have an arm that did direct investing like the Piedmont, and now they're FIS, as well as the manager side, which was the original FIS. So with those two arms, they then renamed and rebranded themselves to Exponents to make sure they were encompassing everything.
Great. Can we just footnote that at the bottom that was formerly NCM?
Yeah.
The reason I say that is because if somebody comes in and is doing their research, they're not going to see they're going to see NCM, and then it goes to Exponents, and not everyone's going to have that privilege of knowledge of knowing that it went through 3 different names before it became Exponents.
Yep. Okay, and then that's fine. And then the other piece I just wanted to highlight, because you did ask about Exponents. We have Exponents also in the global portfolio. They took over the Progress assets. And just to give you a feel, they made some changes and reduced the number of managers. And so Exponents, which was FIS, but now Exponents terminated 4 managers, Activo, Brown, Channing, and Strategic. And then they hired Foresight, Applied Research in Martin, and they maintained ARGA, though they slightly tweaked the mandate. And so just to give you perspective, ARGA now has about 14%. Foresight has about 29, almost 30% actually, 29.999. Applied Research is 25%, and then Martin is 30%. And these are all ACWI ex-US, or I'm sorry, not ex-US, ACWI, all country world managers. That's what they're managing towards. So I wanted to give you that update as well, because that was a difference. And these mandates were implemented 8/27. Excuse me one moment. Let me, I have a child. Apologize, one moment.
Go ahead, Kristen, you good? We're good.
So apologize for that. And then we have, and they traded out of these managers. They were terminated August 6th. So that gives you an idea.
Kristen, that's a note that we have to end our meeting soon.
I know. We've gone over our time. I got a dog running out the kitchen. I got the children and dogs running through the house now. My apologies. You know the world we're living in, so we're trying to do this week.
Kristen, everything is fine. I just appreciate your time.
Yeah. Are there any questions to anything we've discussed today, or any of the transitions and updates that we've received before we end this meeting?
I have one question. What is a basis point?
That's a basis point is 0.01%.
Okay.
So Albert, in 1% equals 100 basis points.
Okay.
So
okay.
Yeah.
So if I say 630 basis points, I'm really saying that I apologize, 6.3%.
Okay.
Mm-hmm. Good question. Good question. So if there are no more questions, can I get a motion to adjourn?
Christina, the only other thing is you wanted, had me send out, I don't know if Kristen wants to comment about the change at Loomis Sales.
Oh, that's right. I'm sorry.
Yep, I can talk about that very quickly. So Jay Park, who's is the CIO, is to retire on March 31st, 2021. This is exactly what we hope to happen, is that they give us advance notice when these type of things are happening. David Waldman is the deputy CIO, and he's promoted to CIO. They have worked many years together. At this point, while we do full due diligence to make sure that there's no issues, we do not anticipate that this is going to be a problem, as they have given us warning that this was coming. And Jay Park and David Waldman worked together for some time.
And I think it's good when we see a firm that really focuses on its management succession, and you have a long track record of somebody who wants to retire at a certain age and someone who's been groomed for over 7 years to take over that position and continue the same strategy in a portfolio. So I was not shocked by that, given that they've worked so long together. Does anybody have any questions on that? Hearing none, can I get a motion to adjourn? And I thank everyone for their time.
I'd like to make a motion to adjourn the investment meeting.
Is there a second? Bobby, second. All those in favor?
Aye.
Aye. Thanks, everyone. Motion is adjourned. Any questions? Sue will touch base. But thank you, Kristen, for your time. I'm sorry we went over. And we'll touch base soon, and we'll try to send out the agenda a little bit earlier next time regarding our November meeting. Thanks, everyone. Have a good evening.
Thank you.
Bye-bye.
Bye-bye.
Bye, everybody.